Hello, Oakblock here, and going to cover TEKMAR. So this is a new idea, and this article is Tech C for TEKMAR. Can TEKMAR Group tug up its price? And this article kind of looks at so let's just maybe start here. TEKMAR, if you went back 5 years or went back 10 years, you can see here it floated at £1.50. Today it's at, well, 5.5p bid and 6p ask. Earlier today it was about 5.5p ask, I think, so it's up a little bit today. But yes, it's as you can see, it's fallen dramatically, 97% fall over 7 years since it floated, and of course did very well pre-COVID, not so well post-COVID. So it is at a 7.5 million market cap, but has some interesting features to it. Has a £50 million 2025 pipeline. So if we just go into here and into here, that we can see some interesting new contracts that it's won. It's I think it's this article here where strength in the pipeline, and 50 million is the sort of near term, with 400 million as a longer term pipeline. And so we're seeing some stronger outlook for the company. So I sort of weigh this up, where on one hand you've got this very, very weak recent past, and but a stronger forward prospects. So it's at a real disconnect, I guess, between its share price and its prospects. So which one will or could win through? So basically, what these guys do are so it's undersea protection for fixtures, fittings. So offshore wind is its biggest single one of those, but also telecoms, interconnectors. So that's connecting basic electrical connections between one country and another under the sea. So there's a few of those running between Britain and Denmark, I think Belgium, Holland, France, Ireland, and so on. And I think even to Norway, if I'm not mistaken. But anyway, and it was very interesting to see that not only are there a lot of these interconnectors today, but there's an awful lot being built out, and not just around Britain or in Britain, but elsewhere in the world as well. Marine civils would be ports essentially, and connected infrastructure. So this picture kind of tells a thousand words as to what TEKMAR do. So it's cable protections, but also all the connectors and bits and bobs that go into the connectivity of wind turbines and other similar. So the company itself runs 11 offices, has then 10 representative offices around the globe. You see them there. The ones in light blue are the TEKMAR offices. The ones in dark blue are the representative offices. But you can see quite a few locations, quite a few in the Middle East, one in China, quite a few in the UK, one in Canada, and then they've got other locations around the world. So for a 7.5 million market cap company, they've obviously got a large footprint, 133 people employed across the business, and a couple of interesting comments actually. 70% spare capacity is one phrase that the CEO gives in the 2024 presentation, which was the most recent one. So that's kind of 6 months ago, but the most recent one. They speak of being able to make 1 million of savings during the current financial year. So they're cutting costs. Their order book is strong. As I say, obviously if you go back far enough, the amount that they've lost is obviously quite considerable in terms of the share price. But what we've got to perhaps start by looking is, well, what does that order book look like? Well, the order book for offshore wind is growing. The build out of subsea interconnectors is growing. Uh, Even gas pipelines are growing. There's plenty of demand, and that's evidenced in this article in a couple of different ways. Um, in terms of Britain, of course, there's a big bet being made on offshore wind and the build out of renewables, and alongside that, interconnectors. So when it's windy in Britain, we can export the power. When there's no wind in Britain, we can import power from other countries. So we can essentially buy and sell power interchangeably, is the idea of interconnectors. And that it's true to say that the post-COVID period, so obviously COVID was 2020, but you actually have to kind of look at the impact on TEKMAR in 2021 and 2022, and then the knock-on effect in terms of the order book and the financials in 2023, 2024. So TEKMAR essentially was getting impacted by COVID kind of 4 years later on than COVID, is my interpretation of the numbers. What you'll see here is these are the awards, so the wind turbine capacity awards. So you can sort of see a growing picture year by year by year, or quarter by quarter by quarter. And this is some stats from an organisation called Westwood Wind Logics, and that's kind of the recent past, or the most recent numbers. If we look forward into what they forecast next of all, well, that 2023, which of course here is a step change upwards from 2022 and a step change upwards from where it stood in 2018, well, that level there gets dwarfed when you look forward into the outlook for demand going forwards into the next few years and then beyond into the 2030s. So there's so there's there's evidence independent of what TEKMAR themselves say about the strong order book out there in the world of offshore wind, but also not just in offshore wind, but in the cable companies that supply the offshore wind. That was the next place I looked. So yeah, this as you can see, this is something, a comment that TEKMAR themselves made, that the pause in 2022 when only 0.8 gigawatts of offshore was consented. Compare that to 2023, 2024, when 19.4 gigawatts. I mean, you can sort of see the difference there. I mean, that's what 20-fold increase, 25-fold increase between those two, 2022 and 2023, 24. But in terms of revenue, and we'll see revenue in a moment, you've got to sort of think of it like it all knocks on. So this next bit is the UK wind map. And again, this was a website I visited that actually shows you wind maps across the whole world. I just took a picture of Britain. So green means it's an operational wind farm. Yellow means it's under construction, and red means that it's in planning, in progress. So you can kind of see even from this, and this is a mature market, perhaps one of the most mature markets, even in Britain. There's significant amounts of new projects, new wind farms coming on stream. Certainly not over, should we say, in terms of the build out of wind Wind farms. So anyway, that covers that aspect. So if we move down, this was the next place that I looked, and to be fair, this was something that TEKMAR themselves talk about in their presentation deck, that there's a 3 times increase to reported backlog. So the last 12 months, and this was taken from about 6 months ago. So I thought, let's go and see what's going on with those 3 companies. So we start with Nexans. We can see the backlog has actually increased in their results to June 30th. That their the backlog's up 16%. If we move on to NKT, NKT, it's down slightly, but they also say that they exclude a 3.5 billion euro contract in that 10.1. So if you include it, it's 13.6 rather than up from 10.7. And then the third one, which is Prismian, which is an Italian company. Again, they're actually their backlog is also up. You can see there has reached 11.2 billion, significant offshore wind contracts as well as interconnection contracts, and it was about 45% for each of those two, and then some residual bits and bobs for the other 10%. So very substantial order books. I mean, vast order books. I mean, it dwarfs the revenue that TEKMAR have been making the last couple of years. And also you've got that whole catch-up thing from post-COVID that, as I say, the bit that takes some getting your head around is, the impact of COVID in 2020 hit the contracts and the contract awards in 2022 that hits the financials in 2023, 2024. Once you put your head around that and you kind of realize, well, hang on, there wasn't COVID, or at least there wasn't a new outbreak of COVID in 2021, or maybe I shouldn't say the word COVID. There wasn't a new virus that hit the world in 2021 or in 2022. Obviously had sort of second lockdown, third lockdown, all that malarkey, but like there's no impact that's going to be hitting the company in 2025, 2026, 2027. It didn't happen in the years afterwards. So there's kind of grounds for thinking that the performance of the last few years, if you agree with and that's what the numbers say, is that the sort of knock-on effect of order book that knocks onto financial results, it all makes sense. I think the fact that they say that there's that 70% spare capacity as well. I mean, obviously, yes, they've cut back on their costs. Those are the numbers for 2024. So you can see that they're making some reasonably good gross profit margins. 32% in this kind of work is exceptionally good levels of profit, I would suggest, in construction, in engineering, those kind. I mean, I looked at hunting not so long ago, a couple of weeks ago. They were making margins of 18.8, and that was super good. And then other divisions were making margins of about 4%, and that was not so great. So for these guys to be making 36 in their marine civils and then 29 in offshore energy, and by the way, they talk about legacy contracts that only earned 25, whereas newer contracts for offshore energy are sort of into the 30s as well. Sort of the aim being to sort of get something like a 35% margin. It is a complete game changer, because I mean, and I sort of do this here. If you say, well, there's a 50, that should be pounds, a 50 million pipeline, 50 million pound pipeline, but also on top of that, they say there's a strong existing order book. So in this article here, summary and all that, the bidding pipeline remains strong, a stronger second half, a stronger backlog. So we get sort of quite a few strongs. So the order book, let's just sort of find that. Yeah. Slower than anticipated conversion into firm orders dampened second half revenue, second half being up to September 2025. Uh, Although the group still expects improved trading when it posts, than when it posted a zero point 0.7 EBITDA loss. It's now adjusted EBITDA is now expected to be break even for the year with a stronger second half, which suggests a 0.7 EBITDA profit. So yes, I mean essentially the business is on an EBITDA basis moving into profit. Now depreciation would sort of negate that to about zero, assuming that they can't grow it any further or faster. But what we see is the pipeline. So this pipeline plus, if we, I mean, and I don't know this is the order book number, but they do say that they have a strong order book. And what I did to kind of say that the order book is, in my estimation, 21.9, was I looked back on their previous order books, and here in the first half of 2024 it was 21.9. So I've gone with that number as my estimate here. But also we can see the pipeline here, so we can see there's dramatically better prospects ahead for this. And then when you sort of consider that there's a 400 million future pipeline, I mean, that takes that 8 times up there somewhere to the top of the page. So that as well is dramatically different. So is any of that in the price? No, not at all. Not a single bit. Not a single bit of it. So yeah, I mean, for me, when I sort of worked through all the numbers and realized that, I thought, wow, actually that's very, very interesting. I mean, if I sort of for a moment say, well, look, let's assume 35% gross margin. I mean, they achieved 36 in the marine civils in 2024, but let's go with 35. Let's assume that they do what they say that they can do, which is to cut overheads by 1 million a year on a run rate basis. I mean, if you do that and you sort of take what they said about, oh, we're running at 30% of capacity. In other words, they could add another 70% of capacity to. They could add essentially a 233% increase to revenue, because that would take them to 100% capacity. If that statement, which at the end of the day is statements they've made, is true, then what we'd be talking about here is a business that generates after tax 20 million a year. Now, a business that generates 20 million a year, I mean, at 10 times earnings, and I'm not saying 10 times earnings is even, like I would say a business like this could earn more, be valued at more than 10 times earnings, but let's say it's 10 times earnings, that would make it a 200 million pound valuation, which of course is dramatically higher than 7.5 million, 26 times higher actually. Now, I don't think that this is on the cards or is sort of in the immediate future. I'm not saying, they don't have infinite demand. They probably are not going to get to 35% immediately. Maybe whilst they've cut their costs by 1 million. I mean, if they tripled their revenue, perhaps they would need to increase their overheads as much as they say that they've got. They're running at 30% of capacity. In the real world, 20 million is probably not on the cards. I'm not saying it's on the cards at all. All I'm saying is that's the sort of, taking their numbers, like I'm not inventing these numbers. These are numbers based upon the statements made in the 2024 presentation. Then that's kind of where you get to. Yeah, I mean, it's not that simple. And to be fair, TEKMAR themselves say, they don't claim that they can achieve 109 million revenue per year with 38 million gross profit margin. But what they do say is that they can achieve double revenue, so double what they achieved in 2024, and what they achieved in 2024 was 54 million. Okay, and so in the next few years, which I'm taking to be 2027, 109 million revenue, so a doubling of revenue, and that's what they call Project Aurora, and that would be achieved through a mixture of product development, market growth, growing market share, and acquisitions. Okay, so that's their plan, and that's what we see here in this slide. So doubling revenue, quadrupling EBITDA profits, achieving operational excellence, making some acquisitions, scaling the business, leads to financial strength, and leads to significant cash flow generation. So one of the interesting things is to grow the business, they don't require a lot of capex. They say that they can scale it just through leverage. You know, that as they grow their sales, that they don't need to invest heavily into more capex to support growth, which I thought was interesting. And as I say, I mean, that 35% gross margin, if they can achieve that, is very, very attractive. Now, if they did achieve that doubling of revenue, that would get them to an overall revenue of 65. Sorry, I said back here that would be the doubling. That's not the doubling. That's more or less a tripling of revenue. This would be the doubling. So the revenue in 2024 was 32 million. Apologies, I think I might have misspoken there. But yeah, you know, about 32.7 million. So doubling it would take you to that 65.6. Put my teeth back in, and a 23 million gross profit margin, which if we take that 1 million less overheads is 10.8. Which would leave us with 12, which if we take off financial costs, so again, I'm just extrapolating past financial costs to sort of say it would be 0.6 of a million. I mean, in reality, they'd probably just pay that off and have no debt, and then you'd have no minus 0.6. But anyway, taking the tax off leaves you to 8.7 million net profit. Now, again, if we just say, well, that at 10 times earnings is 87 million versus today's 7.5 million market cap. So again, you know, there's what, 11 times 11 bagger upside to achieving Project Aurora from looking at their numbers. And again, you know, if there's some slippage on margins, some slippage on overheads, there's some slippage on, you know, not getting to quite double, you know, even if they only achieve half of all of that, you're still looking at about 4 or 5 times today's market cap in terms of a 10 times valuation. And if you said, well, really, so would somebody pay 15 times, 18 times for this business? I mean, they're a market leader. We'll come on to what they are, but you know, there's reasons to think that 10 times, as I say, isn't a particularly aggressive number. I think 10 times would be very, very cheap actually. But let's come on to the quality aspect in a little bit. What about competition? So I mean, one of the interesting aspects was I kind of had a look around at, well, who else does what TEKMAR does, and the answer was, well, there are a few out there, but they're all very large, big conglomerates doing all sorts of things in like medical. So Trelleborg was one example, but they were, you know, doing lots and lots of things in all sorts of industries. They weren't particularly focused on cable protection systems, which is what TEKMAR are. And you can see in this little picture here, this big wind turbine is TEKMAR, and that's the next biggest competitor. So, you know, 5 times fewer. In fact, I did some research and looked up, you know, TEKMAR has supplied over 10,000 cable protection systems. Well, there's only 14,000 wind turbines, maybe 14,500, but you know, they've done pretty much 2/3 or over 2/3 of all the wind turbines that have ever been built. They've run the cables or not run the cables, they've protected the cables once run. So they've got, as you see here, I mean, they are the market leader by a long way. They've got 180,000 analysis hours delivered, 160,000 geotechnical design hours delivered, 100,000 subsea stabilization products in service. That's a lot of products, isn't it? 10 generations of cable products. So their products have gone through 10 iterations or 10 levels of improvement. They worked with 120 wind farms and so on. So they are by far and away the largest player in this. Now, there's a couple of reasons that the share price crashed, and it's interesting because a lot of these reasons are now in the rearview mirror. One of those is the legacy TGP issues. TGP being their TEKMAR, the ticker for TEKMAR, TGP. So the legacy contracts were lower margin, so they've now completed most of those. So these low margin contracts are gone. There was also a warranty issue with cable abrasion and some question over whether TEKMAR was to blame, whether the cable protection had not protected and caused the abrasion. The conclusion at the end of it was that TEKMAR was found to be blameless, that it wasn't TEKMAR's fault that these cables deteriorated or were damaged. The customers obtained compensation from TEKMAR, but TEKMAR got compensation from its insurer. So it's essentially there were some losses relating to the claim, but TEKMAR see it as a learning experience, and also the customer found it a learning experience. So it's made them stronger. And yes, I mean, you could say there's probably about 500,000 of losses in the past, but those are all completed. And if we went into here, we would see that there was a resolution of legacy defect notifications back in August. So that those issues are all resolved. So what maybe would have been seen as an uncertainty or a negative is now no longer an issue. There's also an issue with a Chinese customer that got into a bad debt situation. Speculated it's to do with the Chinese housing crisis. I don't know that that's the case, but they're in construction. I know there's a lot of construction challenges in China, so I'm going to sort of blame it on the China housing crisis. Whether that's true or not, I don't know, but it sounds about right. Anyway, they've been paying off what they owe. They're going to have completed that by the end of this year. So again, things that were potential bad debt or potential legal issues are now all resolved. They're all gone. Debt, obviously, thinking about cash and working capital. Well, net working capital is 6 million. So if you strip out the asset that's being held for sale, then that reduces down to 3.2 million. If you strip out inventory, that number reduces down to 1.5. If you sort of stripped out all the overdue receivables, then you get into a negative. But large customers, small TEKMAR, it's not entirely a surprise that there's some overdue receivables. I think that's par for the course, to be fair. They've also got 6 billion of borrowing headroom. And yes, they do have a CBILS, which is a COVID era business loan that's being replaced by a different loan from the British Business Bank. They've also got a lease liability. So that kind of gives you the period by period the latest wet working capital there. So you can kind of see over the course of these 4 years that net working capital has dropped by about £4 million. The equity, so if you were a shareholder 4 years ago, you would be presiding over something that was worth about sort of 37% less today, or certainly in the last results 6 months ago, than it was worth back then. But that's what happens when a business makes losses over several years, is that the shareholders' equity goes down. That's the story that it's telling you there. What you'll see is that a lot of that is actually just of that 14 million, about over half of it is just wiping off intangible assets. So that would have been sort of goodwill and acquisition costs of companies they've acquired. You can see there's a slight reduction there of fixed assets by about 1.8 million, which is largely to do with this property that they sold off. And then the rest of it is just this net working capital movement down here. So, this 14 million of reduction of loss. Nevertheless, that 25 million shareholders' equity compares to 7.5 million, market cap. So as long as you're happy that, well, at a minimum, you're paying, 7.5 to get 10.1 of tangible assets, 6 of net working capital and 4.1 of that. You're at a 25% discount to tangible assets. You're at a where you're slightly below a net where your net working capital would sort of just that would get you to 4.3, and then it's the fixed assets there that if they're as long as they're worth something, like it's almost like a can't lose price. And then that leaves nothing for the intangibles, which of course relate to the fact that you're buying a business that has sort of 2/3 market share globally on cable protection systems for the rapidly increasing offshore wind industry that's going to grow and grow and grow like Billio, because lots and lots of countries are expanding their offshore wind. I guess you could sort of say, oh well, Donald Trump has been very negative towards wind. Yes, he has. um, but Donald Trump's going to be in power until 2028. He's not going to be able to be in power after that, because you can only have 2 terms unless you go and change the rules, which I don't know. Maybe he'll do that, but this meanwhile, they've got every badge that you could possibly wish for, I think, in terms of project developers, in terms of cable manufacturers, in terms of installation contractors. So all the global players in this market work with TEKMAR. That they've supplied 2/3 of all the cable protection systems, and it's more than just offshore wind. If offshore wind does decline or not grow in the way that it's forecast to grow, then it's not just about the offshore wind, it's about the interconnectors, it's about the gas pipelines, it's about the all the other things going on that go underwater, that and you've only got to think of the geopolitics of this as well, that we know about the threat, the geopolitical threat of cables getting cut or being damaged. So, like, to my mind, there's a whole world of opportunity of, like, well, what if you introduce monitoring or sensors, or ways in which you can monitor for cables being damaged or cut or tampered with. That you could have proximity sensors on vessels that are approaching your cables, that are sending down things to cut your cables. I don't know. I'm just speculating at that point, but you get the idea that this is not an insignificant industry to be involved in. I think it's quite an exciting one, actually, where there's opportunity. So I guess to conclude, TEKMAR seems to be a bit of a no-brainer, and what I mean by that is that when you look at it from a why did it decline? And you could sort of say, well, it's just because they've got rubbish products or rubbish service, but I've found no evidence to any of that. All I've found is that, as far as I can see, that there's just that knock-on effect that's kind of knocked on to the financial results as a delayed COVID reaction, and that obviously is a very but that's the nature of long-term construction projects, is that you feel the effects years after something happens, and that's my interpretation. And equally, the opposite is now happening. There's a build out of demand that's going to take the whole thing the other way, and TEKMAR are well positioned to take advantage of that, and plus they've got the opportunity to acquire, to grow their range of services, to develop new products, to develop ways in which they could achieve recurring revenue. I mean, the CEO talks of that, doesn't go into any detail as to what they would sell on a recurring basis. So hence me starting to speculate about uh, cable monitoring and things like that, which maybe that exists, maybe it doesn't, who knows? But it's to my mind anyway, there's an opportunity here, a high margin business, quality name that works with global players. Yeah, it seems like a great opportunity. So that's enough from me. This article will be published on my Substack, which is theoakbloke.substack.com. It will be published in the next couple of days. Um, None of this is advice, it's just me talking about ideas, and you make your own investment decisions. But I hope that's been useful. Hope that you've learned something new about a new industry. I've certainly learned about it from reading up on it, and yeah, it's quite interesting because you take a lot of these things for granted, and you just assume that it would be all the big companies that do all of these cable protection, but this little specialist company has kind of captured its market share, and now just needs to kind of bounce back from COVID 5 years later and enjoy the fruits of growth and success. So we'll see. Okay, well, that's Oak Bloke signing off, saying cheerio for now. Cheerio.